changes are always good. There's a good changes, a bad changes. That's what it is. So I recently actually Hamilton ETFs has just made a change on HYLD, which is one all-in-one passive income ETF or covered call ETF, and it's very popular. It's one of the most easiest way to have diversify across different sectors. If you're an income investor, rather than buying different ETFs. So this fund particular, this change that they made, so we're going to examine to see if these changes are good or bad, and also there's a reduction of the dividends from this fund, and so we're going to know why there's a changes of dividend. Is it permanent, and is it time for you to exit and maybe sell it and buy something else, or should you stick around? Those are the things that we're going to talk on the I'm going to talk today. And as an income investor, you always have to kind of be on the lookout of what you invest your money in. Not necessarily have to look at a daily charts to know how what's the trading and what the price on a daily basis is not necessary to kind of, or fluctuation of the price on a daily basis is not that important for you to be looking at every day. But also when there is that changes, there are big changes that happens, it's important for you to kind of be aware of, so you don't get caught by surprise. And there's no better place to actually be able to know those changes. This channel, I talk a lot about this type of covered call ETF, passive income covered call ETF, and all type of other type of ETFs. So if it's the first time, just make sure you subscribe, and if you like this this content, just make sure you give it a thumb up, and also hit the bell button so you can get notification whenever I release a video, which I usually do on Sunday and Wednesday. Sometimes whenever there's changes, I can do a video on any of the other days. So let's go. So the change that happened, you all know HYLD. What's HYLD? HYLD is an ETF, all-in-one ETF that track an S&P 500. I made a video on this particular ETF, and if you wanna check the link below, you can, I'll put a link below about this ETF that I made a video on this one, and also I compare this HYLD and other type of ETFs like HMAX, and so now HYLD, adding QQCC, USCC, reducing QYLD, RYLD, XYLD, which these are from Global X, and change in distribution. So they added this one, and also there's a change in distribution. So we'll see why there's a change in distribution. So first of all, if you look at, before we go into deep on this one, let me show you something here. Look at this. Last month, or when I made a first time video, this is a QYLD. Look, it was 16%. If you look today, QYLD is only 7% in weighted. When you look at RYLD, which is a Global X Russell 2000 covered call ETF, was about 15-20%. Today, RYLD is only 7%. So they cut them in half pretty much, and then they added, look at this, QQC is a brand new, it came out at 8%, and USCC was 8.3%. So altogether we're 8 at that time, and now when I made the first video, only 8 ETFs, and now there are about 10 ETF. The last change they made was JP Morgan Nasdaq Equity Premium Income ETF. That's still at a higher price at 15, weighted about 15%. It takes the biggest chunk of it. And of course we have XYLD Global X Nasdaq 500 covered call ETF is about 14%, and JP Morgan Equity Premium about 14%. Those are the biggest one at this moment, and followed by Horizon. This is a good producer at about 11%, and Harvest Healthcare Leaders Income ETF is about 10%. The rest will become less than 10%. So those are the changes. You can see the difference between then and now. So what that means, what all this means to us, passive income investor, passive income investor, does it, adding these has any meaningful, do you have to panic? Do you have to be worried about this? Should we sell your ETF and run away, or should you just stick around? And on this video, I'm going to explain exactly why they added this and what the effect it has on your ETF. So if we go back and we look at what they say actually, the objective of our ETF HYLD, so here adding QQC USA, reducing QLD and RYLD highest yield a greater exposure to recovery from lower coverage. Recently shifted material exposure to QQC USCC from QYLD, XYLD, and RYLD, which we believe offer the following benefits to HYLD. First, as shown in the table below, QQC, or the new one they add, have material high yield, right? That's first, and also reduce, of course, net withholding taxes, because you're a Canadian investor where they have to take the money and pay as a Canadian person, right? So second, the fund added QQC versus QYLD and also LD have nearly identical underlying exposure but lower coverage ratio. So when it comes to market coverage, right, so it does have a more exposure broadly, and also it does have a good recovery, so which should provide a greater upside participation in the market recovery. So because the market was down, because it has 50% above the QYLD, these two will have a greater potential to make your portfolio grow bigger, from the lower prices to higher prices. That's one of the reasons. And also the third reason, we believe this will be beneficial to long-term investors as the market has recovered materially since HYLD's launch in February 2022. Third, going forward, this shift in recovery call strategy should also make underlying distribution of HYLD less sensitive to change in volatility should the micro environment improve. So those are the two benefits. First, it gives you broad exposure, and also it does give you a better chance of recovery from the lower prices to higher price, because the participation of the market is better, and also of course lower your withholding taxes. So why does a change in dividends? Here's one of the things, because now we've seen the distribution. If we look at, let's go here, look at the distribution. HMAX distribution used to be, HMAX actually it's 180. It was 185. I think now it's 180. But look at HYLD. It was 14 cents. Now it's only 12 cents. So the reduction of the dividend, why there's a reduction of dividend? So the reason why they reduce the dividend is because the rule, you can go there and you can read, if the portfolio has a change of distribution, accumulative, like a distribution altogether is 2% and more, then of course your overall monthly distribution also changes. So, and then when they add these two ETFs, of course the change was more than 2%, and therefore there is a change in plus or minus 1%. If there was more than 2%, then that's why there is a change in dividend. But what does this mean? Is it gonna mean that means anything for you to worry about the dividend has being reduced? First of all, you still get from 14 cents to 12 cents. You still get 11.73%. And let's say, for example, market tanks down more, then of course this yield will increase. But right now you're getting about 12 cents rather than 14 cents. Of course, you're missing 2 cents. But the reason why is because when they add these two ETF, has increased the rule of thumb that they put. Rule of thumb here they put, which is it's more than 2% in change of distribution. So that's all you have to know. If you can go here, this is a chart. They put chart pretty well, and also one of the things, if you want to have diversified portfolio, you can also have HDIV and HYLD together. They when it comes to these two, they work well, as they mentioned here, and I actually mentioned about this before. Also that's it. That's the thing that I wanted to bring to you. This is something that came up this last week on Friday. Actually, I received this email on Thursday. So those are the changes. So there's no really need to panic when it comes to HYLD. I think they reduce that, but the benefit, of course, you're going to get more upside and the less volatility of your portfolio, and then it present broadly the S&P 500. It tracks better adding this. So I believe I trust these managers, so there you have it. If you like this content, just like, or if you have any comment, just make sure you leave it below. Thanks for watching. Till we meet again. Bye bye.